Hello, good morning, everybody. Happy New Year, and I hope everybody has been staying safe despite COVID volatility and other occurrences. As you can see, hopefully on your screens in front of you, the title of the presentation, Ready for the Next Round. And that is because, of course, 2022 seems to be starting on maybe a somewhat frustrating note, a new wave of cases fueled by Omicron, some concerns across the region, and it does seem to be repeating the history we've had for the last 2 years. But we do think 2022 ultimately will turn out to be very different from the last few years, as the region, but in particular as Malaysia, we think is finally in a situation where it can move past the most disruptive phase of the virus. And of course, we always unfortunately have to start on, the outlook for the virus, what's happening. And it's no surprise that there's been this massive surge of cases across the world led by the Omicron wave, particularly already having gone through, the West and now moving towards Asia. But we know with the data that's been very clear, even in countries that went through extremely sharp increases in cases, is that fatalities are actually relatively low, and stress on healthcare systems has not been very pronounced in really any country in Europe or the US, or even in emerging markets around the world that have faced Omicron. So that's the good news. It is extremely mild. We know this. And even Malaysia is going through quite a sharp increase in cases now, and unfortunately there will be some disruptions from that. But I think the country is much better prepared than in the past, and the government has the resources in place to manage any disruptions. Of course, the main tool here is the vaccination drive. Fortunately, Malaysia is one of the most highly vaccinated countries, not only in Asia, but across the world, with a booster policy, which is also the top 3 in Asia in terms of the share of the population that's received a booster. So this refers to suggest a high degree of protection in the community, and that's why we're not really preparing for any lockdowns or any significant MCOs. In fact, just last week, the Malaysian government hinted that it's moving forward with reopening of borders despite Omicron. And I think that makes sense. It's in line with what we've seen overseas, in which, we really should not, derail economic growth again for something like this, which is not going to have as big an impact on the healthcare of the nation. So maybe, we're preparing a little bit of perhaps consumer caution in the next few weeks, but we're not making any revisions to our forecasts for 2022 based on COVID or Omicron. Now, I think the main other topic that we're looking at is, of course, the US economic policy, and in particular with regard to inflation and the Fed. And, it's very clear to everybody now that the inflation that the United States is going through is not really transitory. It's not a short, several month phenomenon. It's something that's going to be staying with us for a little bit longer. The inflation print we saw for January showed us that it's not just a few areas of, for example, used car prices, building materials. Actually, inflation is spreading to a wider array of goods and services. And you can see the black line on the left. Even services inflation in the United States is coming higher due to wage pressure, given that many Americans have not returned to the labor force. So we know perhaps monetary policy isn't really the best way to address supply issues, but given that inflation has become such a political issue, it really is eating into incomes. The Fed is constrained to act, and that's led to a shift of market expectations for what the Fed is going to do. So on the left-hand side, you can see that the Fed funds rate currently near the zero bottom. And ultimately, we went even from HSBC's view and market pricing from around 3 hikes for 2022 at the end of last year to now expecting 5 hikes for a total of 150 basis points of tightening. And the reason why that's 150 is because we think now that the Fed probably is going to deliver a 50 basis point hike in the March meeting, given that a few key policymakers on the FOMC have hinted that's a likely outcome. So that degree of tightening was, of course, not expected by the markets, even a few weeks ago. And, as that was priced in, it has led to quite a lot of volatility in risk assets, in particular, tech shares in the United States. Historically, would also have quite a big impact on emerging markets, bonds and FX, and my colleague Joy will talk about the FX, but I think by and large, it hasn't really had as big an impact on capital flows, at least from Asia, as it has in the past. So we are still somewhat hopeful that this kind of round of tightening by the Fed won't be as disruptive. And that's partly because we think that fundamentals in many Asian economies, in particular Southeast Asia, are much better than in previous Fed hiking cycles. And it gives policymakers quite a lot of ammunition as well to kind of defend their currencies where needed. But the other unfortunate equation, aside of this equation, is that, as inflation comes up and the Fed moves to a much more aggressive stance than anybody expected, this will slow growth. So basically, we're already expecting growth in the United States to be a lot slower over the next 2 years. So we've revised down our GDP forecast for 2022 from 3.8 to 3.6, and next year from 2.3 to 2.1. And that's because, as the Fed hiked by 150 basis points, which has a very significant impact on everything from mortgages, consumer loans, it's a broad tightening of financial conditions across the economy. We think that will slow consumer spending and economic activity in the United States. So higher inflation, slower growth in the United States is not a great sign for the global economy. And already, like I'm showing here, we can see after a massive surge in real disposable income during COVID, we have dripped below trend, and we can see very kind of notable pressures on US consumption going forward. But it's not all doom and gloom. I mean, remember, we are coming from a position of strength in the US economy, and in particular, as the US moves away from COVID, and of course, maybe this is, early days still, but I think having been stuck in the United States for some time, that being mild, everybody almost feels that any policy restrictions was an overreaction, and that any new mutations in the future are likely going to be even more mild. So you really perceive, at least in Western economies, that there's no more going back to any types of restrictions from this current juncture. And already you can see places like Canada moving away from even the vaccine passes and restrictions like that. So what that does mean is that there is room for growth in services activity in the United States as we move to a more normal operating environment. The flip side is that might not be great for goods consumption. And that has a particularly strong impact on exports of goods from Asia, which have been extremely strong over the last 2 years, as there's been a change in consumption patterns. But going forward, we think there might be some slowdown in imports from the West. So that's kind of a bit of a warning sign to Asian economies that it's really time to open up domestic growth and unleash consumption and investment. If not, you really can't rely on export engines like we were able to in the past. Now, lastly, a word on inflation in Asia. Headline inflation has ticked higher, but by and large, the inflation pickup is very, very mild compared to what we've seen in the West, where, remember, in the United States, inflation's at a 40-year high. In Asia, it's just a small blip. Now, of course, as economies open up, we will see some more pressure on inflation. We don't think it's going to be as strong as in the US, given that we haven't seen the same disruptions in the labor market as we did in the West. And just kind of to put that in perspective, EM Asia inflation was the lowest in the world last year. So, not only below developed markets, but way below any other emerging market area. So we still think there are somewhat disinflationary dynamics at play. That being said, one area of concern that I do have is food prices in around Asia, partly due to perhaps volatile harvests. And of course, in Malaysia, some disruption from the floods that occurred over the last few months. So we have to worry about some areas, oil prices as well, but we're not expecting a destabilization in terms of core inflation. Now, the other concern, of course, is what's happening in China. We've seen a very kind of notable deceleration of the Chinese economy in the last 6 months, driven by the property market. And I think it is quite interesting that Chinese policymakers, despite loosening up some things on the margin, do remain laser focused on the risks in that sector. And that means we can't really rely on property to be this constant driver of investment in China. And that does point to a slightly lower, perhaps, trend growth rate in China. Yes, manufacturing, high-end, green reinvestment may offset some of that, but the property market is not going to be the same long-run driver of growth in China, and that does have, an impact on some commodity markets, particularly for iron and other machinery used in the property market. We also saw slowing consumption in China, and I think as China remains, focused on the zero COVID policy, which entails sporadic lockdowns, we're likely to see other flare-ups and restrictions, and that means, the Chinese economy is entering, at a relatively weak position right now, and that means likely to see more easing from the PBOC. Granted, quite small, doses of easing of RRR cuts or policy rate cuts, but by and large, we do think the credit impulse should have bottomed out in China, and we do expect more policy to support to help stabilize things. And like I mentioned earlier, goods consumption in the West is going to start declining. So really, when we look at exports in emerging markets, particularly in Asia, we've likely already peaked from here. And that does point to some slowdown coming from last year. Another issue that we've been looking at is some of this production bottlenecks in the West. Fortunately, those are starting to recover somewhat. And at the same time, we do see an improvement in backlogs in Asia. One of the biggest backlogs was, of course, in the semiconductor sector, which was mentioned earlier by Stuart, particularly automotive chips, where Malaysia is a key producer. Now, we see some signs of improvement there, so that should help kind of open up manufacturing capacity and exports. But again, we're looking at a very mixed picture because of slowing growth. So ultimately, we expect export volumes to decrease somewhat, but still remain somewhat resilient. And one reason why we still are somewhat optimistic, at least for Malaysia and Southeast Asia, is that we do see FDI inflows remain strong into ASEAN, especially Malaysia, given that it remains such an important part of the global semiconductor sector. Firms had no choice but to expand production. So the Malaysian manufacturing sector is entering 2022 on a relatively strong note. But let me just look at Malaysia more holistically to give a little bit of an outlook on where we are right now. So if you think about growth last year, it came in at the lower end of the government's 2 to 3% forecast. And just to put that in, 3 to 4% forecast. And just to put that in perspective, we came into 2021 expecting growth in Malaysia near 7 to 7.5%. The government was looking at something as high as 8%, and we ended up coming closer to 3%. So that just shows you how disruptive the MCOs from last year were. Coming into 2022, despite this increase in Omicron cases, actually mobility in Malaysia has been more resilient. Malaysia is this blue line. So you can see, in the summer of last year, we were at negative 60% of the mobility from pre-crisis, pre-COVID. Now we're at around negative 20, and we don't expect it to get too much worse from here. So that's why we're not seeing any strong reasons for concern, especially if the Malaysian government doesn't impose new restrictions. So we do expect an improvement from growth from here. 4Q GDP did suggest that there was broad-based growth in the Malaysian economy. So be it consumption, exports, investment, everything picked up, albeit at a slightly slower pace than we were expecting. But if we look at forward-looking indicators, such as consumer sentiment index, business condition sentiment, actually those are pointing higher. So we are seeing all the pieces in play for a more resilient recovery in Malaysia over the next few months. And that's ultimately why, we are looking still at Malaysia as being one of the stronger growth stories at around 5.6% GDP in 2022 in Asia. And one of the key drivers of that, I mentioned that before, is on the export side. Malaysia's net exports trade surplus is actually, again, reached a record high in the latest data. And, that's actually still perhaps somewhat understating the strength of the trade sector in Malaysia, because actually, if you look at palm oil and LNG exports from Malaysia, they're actually, they're doing well on value terms because the prices of the exports are high, but actually the volumes are quite low. In the CPO sector, that's because of issues with migrant workers from Indonesia. There's been very strong labor shortages, and Malaysia hasn't been able to produce as much CPO than it would otherwise. Last year, towards the end of the year, the government did come up with a few agreements to accelerate foreign labor coming into Malaysia. So we expect volumes, at least of palm oil production, to increase in the next few months. Same thing with LNG, as a few key pipelines are repaired. So what I'm trying to say by this is, import growth is recovering in Malaysia as the economy reopens, but we're also seeing some positive catalysts, such as higher volumes of exports, some rebound in tourism, at least within ASEAN, let's say Singaporeans, for example, other people from ASEAN, perhaps overseas, and the fact that, like was mentioned earlier, Malaysia is still riding on this semiconductor wave. all the semiconductor companies, or at least most of them, that released their kind of capex and their production volume forecasts in the last few weeks were still quite bullish. So be it the likes of TSMC, Samsung, Micron, all the big producers, they all kind of signaled relatively bullish outlooks. And ultimately, we think Malaysia is going to benefit on that. So yes, trade growth is slowing, but Malaysia, we still think, is in a very good spot, thanks to the diversified nature of its exports. Now, the key question is, what does that mean for then the broader economy? And the truth is that while Malaysia's manufacturing sector still remains very strong, when you look kind of at other aspects of the economy, the outlook maybe isn't so strong. Be it, for example, the pockets of manufacturing excellence, such as rubber gloves, are seeing some concerns, maybe as COVID slows. Also, the construction industry is facing, very high labor costs, also given some labor shortages, issues with foreign labor. So, it's not as broad-based a growth story in Malaysia that we'd like to see. And that's why ultimately we continue to expect the government to give at least some incentives to boost productivity for other sectors of the economy. Now, when it comes to inflation in Malaysia, we did have a spike in inflation in the early part of 2021, and that was because of energy price changes, electricity tariffs. So in a sense, Malaysia already saw some price adjustment in 2021, and that's why between 2021 and 2022, we don't expect much of a change in inflation. Headline inflation will be relatively constant, actually, between those 2 years. But what will change is core inflation. Core inflation is running close to sub 1.5% in Malaysia. And we only think it's going to start approaching that 1.5 to 2% range towards the second half of this year. Because like I mentioned, the consumer recovery will probably accelerate after Omicron eases a little bit. You're already seeing some pockets of wage growth in certain industries in Malaysia. And once you see just a little bit of respite on the tourism side, we do expect broader wage growth to rebound close to 3 to 4% by the end of this year. And that should push core inflation in Malaysia higher, towards at least 2% by the fourth quarter. So when it comes to the central banks, how it looks at the economy, we do think there will be a case for policy tightening in Malaysia in the second half of this year. Now, many questions we get is, okay, as an emerging market central bank, wouldn't Malaysia have to be very wary of what the Fed is doing? So, for example, wouldn't there need to be, B&M having to hike perhaps alongside the Fed or before the Fed? Because if you look at in the past, Malaysia Central Bank tends to be one of the first central banks to tighten policy, to raise interest rates, because they're quite concerned about inflation or financial stability. But we don't think that's going to be the case this time around. Like I mentioned, demand hasn't fully recovered in Malaysia, and at the same time, inflation is really not a concern for right now. And then if you look at loan growth, total financial financing issuance, it still remains quite low. This is the gray and the red line you see in this chart. So we don't think there's a case at this time to raise the policy rate. We only think B&M is going to hike interest rates by 50 basis points, and at the end of the year, before accelerating its hikes into 75 basis points next year. So in short, we think B&M will be patient. Despite the Fed hiking 150 basis points, we only see 50 basis points by B&M, and that's ultimately because Malaysia's economic fundamentals are very different. Malaysia, yes, will face some inflation, but nowhere near the degree that the Fed or that other central banks in other parts of the world are seeing. So there will be a very notable divergence between monetary and fiscal policy, between monetary policy in Malaysia and other parts of the world. Other concerns that B&M looks at is, of course, on household debt. Household debt growth has jumped higher in Malaysia, close to 93%, and we do see, of course, renewed activity in the housing market. So that is, perhaps a concern, but we ultimately don't think B&M is going to use the policy rate anytime soon to address that. If anything, we think they'll look more at macroprudential policies, such as loan-to-value limitations, if they need to kind of contain lending in that part of the economy. Yes, so in short, we think actually Malaysia will be quite insulated from what the Fed is doing, at least for the first half of this year. and only initiate on a hiking cycle in the second half. And actually, the governor of BNM did come out a few weeks ago to say something similar along those lines, that Malaysia can be patient, and that there is no immediate move if it's expected. So that's a very quick run through of how we're looking at the global and Malaysian economies this year. I look forward to your questions later on in the presentation.